In the middle of an active war, gold dropped 22% from its record high. That alone should stop you. Oil supply was under threat. Inflation was climbing. The dollar was wobbling. Every textbook rule of safe haven investing said gold should have been ripping higher. Instead, it cratered. And in a single trading session, it gave back an entire year's worth of gains. Not because of a missile strike, not because of a ceasefire collapse. It happened on a piece of economic data that most people scrolled past without a second thought. Naturally, a lot of people jumped to the obvious explanation. This was rigged. Someone wanted gold to fall, and they made it happen. Here's the twist. They're not entirely wrong, but not in the way most people imagine. There was no secret room, no backroom phone call, no coordinated takedown. What actually happened is, in a strange way, more revealing than any conspiracy theory could be, because it tells you precisely who was forced to sell, precisely why they had no choice, and precisely what tends to happen next. Once you see the full picture, you'll understand why the most sophisticated buyers on the planet were quietly loading up on gold at the exact moment retail investors were dumping it in a panic. By the end of this, I'm going to walk you through three things. First, who actually sold the gold and why their hand was forced. Second, the single piece of data that proves this was less a breakdown and more a setup. And third, the real plan, not written by any committee, but dictated by $39 trillion in debt that the new Federal Reserve Chair inherited the day he walked into the building. Stick with me, because by the end of this, you will never look at a falling price the same way again. Let's start with the timeline, because the precise sequence of events is what unlocks everything that follows. Gold hit an all-time high of approximately $5,589 in January of 2026. Then the conflict with Iran erupted, and over the following months, gold did not behave the way classic safe haven logic predicts. It didn't climb, it fell. By mid-June, it was trading near $4,330, and at one point, it had surrendered the entirety of its year-to-date gains in a single session. What triggered that single-day collapse? Not a geopolitical shock, a stronger-than-expected May employment report. The economy added roughly 172,000 jobs against a forecast of around 85,000, more than double what economists expected. And gold dropped over 3% in a matter of hours. Sit with that detail for a second, because it's the key that unlocks the entire puzzle. Gold didn't collapse on war news. It collapsed on a jobs report. And understanding why a labor market print can move gold more violently than an actual war is the difference between seeing this decline as a breakdown in the gold thesis and seeing it for what it actually is. Here's the mechanism, and it's simpler than people think. Gold does not primarily trade on fear. It trades on the real return available from the alternative to holding it, which means it trades on interest rates adjusted for inflation and on the strength of the dollar. When a hot jobs report lands, it tells the market the economy can absorb higher interest rates for longer, which means the central bank is less likely to cut anytime soon. Expectations of higher for longer push bond yields up, and gold, which pays you nothing simply for holding it, becomes relatively less attractive the instant a government bond is reliably yielding you 4% or 5% with none of the volatility. At the same time, that strength and those higher yields pull global capital into the dollar. And because gold is priced in dollars worldwide, a stronger dollar mechanically suppresses gold's price for every buyer outside the United States, even if nothing in their local market has changed. So when people say gold should rise during a war, they're working off an incomplete mental model. Gold's behavior during a geopolitical crisis depends entirely on what that crisis does to three downstream variables: inflation expectations, interest rates, and the dollar. And the Iran conflict, by sending oil prices higher, pushed inflation expectations up, which pushed rate cut expectations down, which pushed bond yields up, which pushed the dollar up. Three forces, all converging on gold from the same direction, all pointing down at the exact moment the headlines were screaming that gold should be soaring. That's layer one. But it still doesn't fully explain the word on purpose in the title. For that, we need to look at who was actually doing the selling, because the price decline wasn't purely mechanical. It was accelerated, hard, by specific sellers with specific identifiable motives. The first group of sellers were the central banks of energy-importing nations under acute fiscal stress. When the Strait of Hormuz, the choke point through which roughly a fifth of the world's seaborne oil flows, was disrupted, nations dependent on imported energy suddenly needed dollars, urgently, to keep paying for oil that had just gotten dramatically more expensive. And when a central bank needs dollars fast, it sells its most liquid, dollar-denominated asset. For most central banks, that asset is gold. Turkey is the clearest documented case. With the lira under enormous pressure and repeatedly hitting record lows after the conflict began, Turkey's central bank ran gold-for-dollar swap operations that registered in the data as net sales. This wasn't a statement of distrust in gold as an asset. It was a country raising emergency cash by liquidating the most valuable, most liquid thing sitting in its reserves. The second group were the war financing states. Russia, the world's fifth largest sovereign holder of gold, had already begun selling gold in 2025 to help fund its ongoing military spending in Ukraine, and that selling carried into 2026. When a government needs to monetize its reserves to keep funding a war, gold is almost always the asset it reaches for, because gold can be sold into deep, liquid global markets without the political baggage that comes with liquidating other types of reserves. The third group, and this is the most mechanically important of the three, were the leveraged and institutional holders inside the paper gold market. During gold's extraordinary run toward its January high, enormous positions had built up across futures contracts, leveraged ETFs, and derivatives. When the price started falling for the structural reasons I just described, those leveraged positions started getting margin calls. A leveraged long position that moves against you forces a choice: post more capital or sell. As the price dropped, leveraged holders were forced to sell. That selling pushed the price lower. The lower price triggered more margin calls, which forced more selling. This is the exact same self-reinforcing cascade that shows up in every leveraged market unwind, in every asset class, every single time. And it compressed what might otherwise have been an orderly, gradual correction into a sharp, violent decline. So now you can see the actual shape of on purpose. Nobody coordinated these three groups: Turkey's central bank, Russia's treasury, and a leverage fund somewhere in London facing a margin call were not on a conference call together. They've probably never spoken. But each one was acting deliberately in its own rational self-interest, and the sum of those individually deliberate decisions produced the crash. It was, in aggregate, the result of many purposeful actions, which is a fundamentally different thing from a conspiracy and a far more useful thing to actually understand, because it tells you something important about whether this selling pressure is likely to continue. Now let me show you the evidence that this was a positioning event, not a fundamental thesis break, because this is exactly where the people calling the top of gold are making their mistake. If the decline in gold genuinely reflected a deterioration in its fundamental investment case, you'd expect the largest, most informed, longest time horizon buyers in the world to be reducing their exposure right alongside everyone else. The data shows the opposite. Central banks as a group bought a net 244 tons of gold in the first quarter of 2026, above both the prior quarter's total and the 5-year average. There was a 1-month pause in March, driven primarily by the Turkish swap maturities I described earlier. And then in April, central banks came roaring back into net buying. Poland's central bank led the pack with 14 tons in that month alone, pushing its year-to-date total to 45 tons and its total reserves to roughly 595 tons, close to 30% of its entire reserve position. China's central bank added another 8 tons on top of that. Think carefully about what this tells you. The pace of sovereign accumulation did not slow down in response to the price correction. The same institutions whose entire job is managing national reserves over the longest possible time horizons with the most comprehensive view of the global monetary system available to any actor on Earth kept buying straight through the decline. Meanwhile, the selling that actually drove the price down came almost entirely from forced sellers, nations scrambling for emergency liquidity, war-financing states monetizing reserves under pressure, and leveraged funds getting margin called out of their positions. The buying came from strategic, long-horizon accumulators. The selling came from forced, short-horizon sellers. And when forced sellers run into strategic buyers, the price falls in the near term, but the asset itself migrates from weak hands into strong hands. That's not a thesis break. That's a transfer of ownership. And the demand data backs this up completely. Total global gold demand in the first quarter of 2026 hit a record 1,231 tons, worth a record $193 billion, up 74% in value year on year. Bar and coin demand alone rose 42%. So you had record demand in dollar terms during the exact same period that the price was getting hammered. That divergence, a falling price sitting right next to record-breaking demand, is the unmistakable signature of a market where the paper price is being set by forced selling and leveraged unwinding, while genuine underlying demand for the physical metal is stronger than it has ever been. Now we get to the real plan. Not a conspiracy, a macroeconomic reality that makes gold's longer-term direction close to inevitable, regardless of what the paper market does in any given quarter. The United States is currently carrying a national debt of approximately $39 trillion. Annual interest payments on that debt have now crossed $1 trillion, more than the entire defense budget, consuming roughly 19 cents of every dollar of federal revenue collected. And here's the constraint that defines everything downstream of it. At debt levels this large, the government simply cannot afford to sustain high interest rates indefinitely. Every additional month of elevated rates tax on tens of billions of dollars in additional interest expense, which widens the deficit, which requires even more borrowing, which then requires either higher rates to attract lenders or monetary accommodation to suppress those rates artificially. This is precisely the trap that the new Federal Reserve Chair, Kevin Warsh, inherited the moment he was sworn in this spring. He's facing inflation that argues against cutting rates, sitting right next to a debt burden that argues against keeping rates high. There is no clean, painless path between those two pressures. Pick one and you make the other worse. When a government finds itself facing a debt burden of this scale, history offers a remarkably consistent resolution. It's not default. It's not austerity severe enough to actually pay the debt down in real terms. No democracy has the political stomach for that. The resolution is financial repression, a sustained stretch of time where interest rates are deliberately held below the rate of inflation, allowing the real value of the outstanding debt to quietly erode while nominal economic growth gradually shrinks the debt-to-GDP ratio over the years that follow. This is almost exactly how the United States worked off its World War II-era debt burden over the following 2 decades, and it's an environment in which the purchasing power sitting in cash and conventional bonds gets steadily, silently transferred away from savers, while the assets that hold their purchasing power are precisely the ones that no central bank can simply decide to create more of. Gold is the purest asset of that kind that exists. Its global supply grows by roughly 1% to 2% per year through mining. Full stop. No policy meeting, no emergency session, no committee vote can speed that up. In a world where the dominant reserve currency is being created at a pace dictated by fiscal necessity rather than monetary discipline, the one asset whose supply is constrained by geology becomes the natural destination for capital that's trying to escape the slow, grinding erosion of currency debasement. That is the real plan, not a plan to crash gold, the underlying fiscal trajectory that makes any crash in gold a temporary suppression rather than a permanent reversal. And it's exactly why the sophisticated, long-horizon buyers kept accumulating straight through this decline. They were never trading off the jobs report. They were positioning for the resolution of a debt problem that history says has only one realistic, politically survivable escape route. And they used the forced selling from stressed nations and over-leveraged funds as an opportunity to buy the asset at a discount relative to where the fiscal arithmetic says it's ultimately heading. Let me now place this moment inside the broader pattern that has repeated after essentially every major oil shock of the last 50 years, because the shape of it is remarkably consistent. Phase 1 is the acute shock, the geopolitical event itself, the forced selling, the sharp, violent price decline. We've just walked through that phase in detail. Phase 2 is consolidation. The price recovers slowly, unevenly, with fits and starts. Mainstream sentiment stays skeptical, and the negative narrative continues to dominate financial media, even as the underlying structural forces keep building quietly beneath the surface. Phase 3 is institutional recognition. The informed buyers, the ones actually tracking central bank flows and physical demand data rather than headlines, build their positions ahead of the broader market catching on. Phase 4 is public recognition. By this point, the price has already moved significantly. The mainstream narrative finally flips positive, and the same investors who sold in a panic during Phase 1 scramble to re-enter at prices well above where they originally exited. Everything I've laid out for you. Record physical demand, running alongside a declining paper price. Central banks returning decisively to net buying in April. Virtually every major institution maintaining gold price targets well above current levels is entirely consistent with the early stages of Phase 2. The structural forces are building. Sentiment just hasn't caught up yet. Goldman Sachs stripped every single rate cut out of its 2026 forecast, and yet left its gold target sitting near $5,400, explicitly citing central bank demand as the structural floor underneath the price. JP Morgan set a target of $6,300 earlier in the year. UBS, even after trimming its own forecast somewhat, still sees meaningful upside from current levels. The professional research that actually tracks the fundamental drivers, not the headline chasers, has not called this a breakdown. It has called it a discount. I want to be precise about what I'm claiming here, because intellectual honesty matters more than conviction. I am not telling you gold cannot fall further in the near term. It can. The leveraged unwinding may not be fully complete, and if the conflict resolves in a way that briefly strengthens the dollar further, gold could test even lower levels before this is over. What I am saying is that the structural forces underlying gold's value, the debt burden constraining the Fed's options, the fiscal trajectory pointing toward financial repression, the central bank accumulation that has continued regardless of price, the physical demand sitting at record highs, are not only fully intact, they're more pronounced now than they were back at the January high. The price fell, the thesis got stronger. Those two facts coexist simultaneously, and the gap between them is exactly where the opportunity lives. The deepest lesson buried in all of this is really about how to read a market when price and fundamentals diverge from each other. Most investors treat the price itself as the verdict. When gold falls, they conclude the gold story is finished, and they sell. often at precisely the moment that forced sellers and leveraged unwinding have pushed the price to its most attractive level relative to the underlying value of the asset. The investors who build durable, generational wealth do the opposite. They ask one question first: who is actually selling and why? They distinguish between selling that's driven by a genuine change in the fundamental thesis and selling that's driven by liquidity needs, leverage, and mechanical forces that have nothing whatsoever to do with the asset's long-term worth. And when they identify that the selling pressure is mechanical, while the underlying fundamentals remain intact, they recognize the decline for what it really is, a transfer of ownership from the forced to the strategic, and they position themselves accordingly. That's exactly what the central banks of the world are doing right now. They're not panicking over a single jobs report. They're quietly accumulating a monetary asset at a discount created by other people's forced selling, in anticipation of a fiscal resolution that history strongly suggests is close to inevitable. Gold was crashed on purpose by no one in particular, and it's being bought on purpose by people who have complete clarity about exactly why. The plan was never to crash gold. The actual plan, written not by any committee, but by the cold arithmetic of $39 trillion in national debt, is the slow, deliberate erosion of the value of money itself. And within that plan, the temporary suppression of gold isn't the end of its story. It's the setup for the next chapter of it. The price tells you what the forced sellers did last quarter. The fundamentals tell you what the strategic buyers are positioning for over the next decade. Decide for yourself which one you're actually reading. If this kind of deep, evidence-based breakdown is useful to you, subscribe to Untold Empire. This is exactly the kind of analysis we'll keep building out as this story develops.